If you're thinking about leaving Canada in 2026, there is one big tax mistake that I want you to avoid. That is assuming that once you move, the CRA is done with you. In many cases, the opposite happens. The moment you cease to be a Canadian tax resident, the CRA may treat you as if you sold certain assets at market value, even if you didn't sell anything. That's what people usually mean by departure tax. In this video, I'll walk you through exactly how this works, who it applies to, what property is affected, what forms matter, and the biggest planning mistakes that I see. I'm Dennis Goossen, I'm a CPA, and I help people navigate Canada, US, and other cross-border tax issues. So first, let's clear up a big misunderstanding. Moving physically is not the same thing as ceasing Canadian tax residency. The CRA looks at whether you're actually severing your significant residential ties with Canada. The main ties CRA cares most about are your home in Canada, your spouse or your common law partner in Canada, and your dependents in Canada. They might look at secondary ties like personal property, social ties, bank accounts, credit cards, driver's license, passports, and provincial health coverage. So, if you leave Canada but keep strong ties in Canada, you may still be a factual resident. And in some cases, if both Canada and the other treaty country claim you as a resident, treaty rules can become relevant as well. The CRA also says that when you leave to settle in another country, you usually become a non-resident the latest of the date you leave Canada, the date your spouse and dependents leave Canada, and the date that you become a resident of the country you eventually settle in. So before you even calculate your tax, step one is getting your departure date and your residency status right. Once you cease Canadian residency, the CRA treats you as having disposed of your property, certain property, at fair market value immediately before departure, and then immediately reacquiring it at the same amount. It's a deemed disposition that can trigger capital gains even though no actual sale happens. People get shocked by this. They think I'm still owning the investment, so why do I owe tax? The answer is that Canada wants to tax the growth that accrued while you were in a Canadian residence. So you own appreciated non-registered investments, private shares in companies, cryptocurrencies, or other certain properties. That unrealized gain becomes taxable on departure. The CRA says the deemed disposition applies to most property, but there are important exceptions. Major categories that are generally excluded include Canadian real property or immovable property, land, houses, real estate, etc. Canadian business property, well, the business is still being carried on through an establishment in Canada. Registered plans like RRSPs, RIFs, TFSAs, RESPs, so forth. There's also a special rule for some people who are resident in Canada for 60 months or less. Certain property they owned when they last became a resident can be excluded as well. So this is where the planning matters. A lot of people hear departure tax and assume it applies to absolutely everything, and it doesn't. But the list of what's excluded is pretty technical, so you want to classify your assets carefully. There's 3 forms that people commonly need to know here. First, there's Form T1243. That's the form that's used to calculate and report your gains and losses from the deemed disposition. Second, there's Form T1161. That's the form that's if the total fair market value of the property that you own when you leave Canada is more than $25,000. This form will list your properties that are subject to exclusions. There's a late filing penalty for this form of $25 a day up to a maximum of $2,500. And then the third form is Form T1244, which is if departure tax is triggered, the CRA allows an election to defer your payment of tax on the income related to that deemed disposition. This election must be made by April 30 of the year after your emigration, and if the federal tax involved is above certain thresholds, security may be required. So even where the tax result is manageable, the compliance side is not something I'd leave to guesswork. Here are the greatest common mistakes that I see. Number 1, assuming that your departure date is simply the date you cross the border. That's often wrong. Residency is based on facts and ties and treaty positions. Mistake number 2, people think they can keep their Canadian ties and still call themselves a non-resident. You can't. Mistake number 3, you ignore the information forms. Even when there's not a massive tax bill, missing forms still can create penalties and problems later. Mistake number 4, not getting proper valuations. If you're relying on fair market value at departure, especially private company shares or other unusual assets, documentation matters. I see this mostly with private corporations, private companies that you own. And mistake number 5 is not thinking ahead about what will happen after departure. For example, the CRA notes that if you later reestablish Canadian residency, you can actually elect to unwind that previous deemed disposition. And then, of course, if you dispose of the Canadian properties after emigrating from Canada, there's additional reporting steps. Let's walk through a simple example. Somebody leaves Canada permanently in 2026, becomes a resident of the United States. They sever all their Canadian residential ties, and they own an investment portfolio, unregistered, with large unrealized gains. They have a bunch of stocks and bonds. There's large gains in there. You have a deemed disposition when you leave Canada on that departure. You report that on a T1243. The relevant property exceeds the reporting threshold, so you also report it on a T1161. A large tax, and you don't want to sell your stocks and bonds, so you can consider whether you want to file the T1244 and defer payment on the tax. In many cases, you would need to give security on those stocks and bonds to Revenue Canada so that you can defer the tax until at such time as you ultimately sell those stocks. A second example, by contrast, would be if you own a Canadian house. If you own a Canadian house, that property is not part of the deemed disposition for departure tax purposes because it's real estate. But that does not mean there aren't future Canadian tax issues on that actual sale. So the key takeaway is this. Leaving Canada does not automatically end your Canadian tax exposure cleanly. You need to ask yourself 4 questions. 1, did you actually cease being a Canadian resident? 2, what is your actual correct departure date? 3, which assets are caught in this deemed disposition rule? And finally, 4, what forms and elections apply? If you want, the next video I do will be on how to become a non-resident of Canada step by step, and the biggest mistakes people make when they move from Canada to other countries. Thanks for a bunch, and have a great day.